All right, guys. Well, welcome to today's webinar. Thank you so much. We have great attendance today. I'm going to try not to be too boring. We're going to talk about some interesting concepts that I think are very simple that we can all utilize in our everyday money management, whether we are traders or whether we're investors. I think that these are concepts that I think all of us as investors should be aware of. And then we're going to talk about some trade ideas and get going. So without any further ado, let's rock. So today's agenda, what we're going to start with is I want you guys to put things in everything that I discussed moving forward into context, right? So the first thing that we're going to do is talk about my top-down approach. Very simple, how we approach the markets when we walk in on Monday morning. What is it that we're looking for? How do we get this process going? Then we're going to talk about how we're going to analyze any chart in 3 very simple steps. Then we'll talk about the current environment. Like I said, I'm going to present you guys with 5 stock trades in total. We'll start with the first 4. Then I'll give you a nice little a tour of allstarcharts.com. And then we'll finish up with what I think is the best chart in the world. So let's go. So I know some of you here do know me and are familiar with my work. You know, I founded All Star Charts a long time ago. But just a little bit about myself personally. I got going at 21 years old. I was at Fairfield University in Connecticut. I was new to the Northeast after, growing up down in Miami, Florida. And I had the great opportunity to intern at Merrill Lynch back when that was actually a company, a good one, in fact. And, it really opened my eyes and it really first kind of showed me what the market was all about. And it really attracted me from day one. So early in my career, I hit that proverbial fork in the road. Do I learn about fundamental analysis and study for my CFA designation and learn about companies? Or do I want to learn about the market and learn about stocks and get my CMT designation and go the technical analysis route? That was really that fork in the road. And, little did I know back then how important that decision would really shape not only my career, but really my entire life. Moving forward, and has given me so many incredible opportunities. So needless to say, I chose the technical analysis route. I literally just read, any book I can get my hands on, starting with the Bible itself, technical analysis of stock trends. And by the way, if you guys, if you're interested in this list, just go ahead and email me, jc@allstarcharts.com, and I'm happy to forward this over. So it's jc@allstarcharts.com. But basically, it really opened my eyes that technical analysis is not just squiggly line up, squiggly line down. There's a lot of intermarket relationships and many different techniques with respect to using multiple time horizons and including seasonality and sentiment, as a supplement to price behavior. So it's really, and we're going to get into some of that today. So fast forward to 2008, summer 2008, I had already earned my CMT designation. I had passed all 3 levels, and shortly thereafter, in 2010, I founded allstarcharts.com, really just as a humble blog to share ideas that I was seeing out there in the market and kind of just, doing my technical analysis really for the public. And again, as time goes on, shortly thereafter, I founded my own company, Eagle Bay Capital, in early 2012. So we're about to hit that 5-year anniversary next month, which is very, very exciting. And then in 2014, I launched the premium research product, allstarcharts.com. So, a lot's happened. It's been an amazing journey. Over these years, I've had the opportunity, my work has been featured on Bloomberg. It's been featured on ABC and CNN. It's been featured on CNBC, on Fast Money, and Yahoo Finance, Wall Street Journal, Canada's Business News Network, and it's given me a great opportunity to kind of understand the way the media works, both the good and mostly the bad, kind of see how the sausage is made and, why it is that all of their ratings are going down. So it's really given me a great opportunity to find out why it is that they're so bad by being behind the scenes and trying to be able to profit from that as a market participant, being able to filter through the noise, really understanding what the media's objectives are and what our objectives are as market participants. So let's get into the top-down approach. This is very simple. We really want to start out with a bird's eye view, kind of, think of yourself out in space, looking the entire world, both the U.S. indexes and the international indexes. So while of course we're looking at it on a weekly basis. We're looking at the Dow Jones Industrial Average, S&P 500, NASDAQ, Russell 2000, Mid-Cap 400, New York Stock Exchange Composite. All of these U.S. indexes all play a role in the analysis. But then we go overseas and we're seeing what's happening in the London FTSE 100, the France CAC, the DAX in Germany, what we're seeing in Asia, not just from the emerging markets like the China, Shanghai, and South Korea and things of that nature, but also some of the more developed nations in Asia like Japan, Hong Kong, Australia as well. And what, of course, what's happening in Latin America and South America. A lot of exposure down there to metals and mining and energy in countries like Brazil, Colombia, Chile. So we're looking at all of these markets and taking a weight of the evidence. Okay, and I find, by the way, guys, a lot of you guys are in America. I find so much value in looking internationally. If I had to pick one or the other, even though I focus on U.S. equities strictly for informational purposes, if I had to pick one or the other, which fortunately I do not, I would pick looking at the international indexes over the U.S. indexes because I believe they give us more information. But fortunately, we have the advantage that we get to look at all of them, and collectively as a unit is really how we want to approach the marketplace. So once I get a global perspective, then I want to break it down into the individual sectors, right? So I mentioned before, Latin America and emerging markets, and a lot of those countries are very closely tied to a lot of the sectors here in the United States, things like metals and mining and energy, basic materials and things of that nature. So by looking overseas and then breaking it down one step further to the sector level, we'll already start to be able to pick up themes in terms of where is money flowing into, where is money flowing out of, right? So we've seen a ton of money flowing into things like financials, for example, and out of some of the interest rate sensitive sectors like utilities and real estate investment trusts and telecom, right? And going into some of the areas that benefit from higher interest rates, and any of these stocks that pay high dividends have really gotten hit pretty bad. So again, by going sector by sector, we're seeing that. I haven't even gotten into my interest rate charts, and just by looking at the sector rotation, I could pretty much tell you what interest rates have been doing. So then once we figure out the sector level, let's just say we like energy for whatever the reason, then we break it down to the subsector. Okay, so you like energy. What in energy really stands out as the best risk versus reward opportunity? Are we looking at the integrated names like the Exxons and Chevrons, right? Do we want to be in the big boys, or do we want to be in some of the oil services companies, or do we want to be in the explorers, or do we want to be in the refiners like Valero or Tesoro, right? What area, what group of energy do we want to be within that sector? And then finally, we break it down to the individual names. Let's say, hypothetically, we want to be in the oil services names for whatever the reason. Maybe they're showing the most relative strength or the best risk reward or whatever the case may be. Then we break it down to the stock level and say, okay, are we better off just owning the entire oil services group, just buy OIH and call it a day? Or do we want to break it down to the individual sector level? Perhaps a Halliburton or a Schlumberger might offer a better risk versus reward opportunity. So guys, this very simple is what we call the top-down approach, starting with the bird's eye view and then working our way down, as opposed to a bottoms-up approach where hypothetically I buy a cell phone and say, oh, this is a beautiful cell phone, it's so great. Let's see what company makes this cell phone. Ooh, Apple makes it. All right, terrific. Well, let me convince myself over the next 2 weeks of why I should buy this stock, even though I already have an inherent bias in that because I have dedicated 2 weeks of time. So I'm simply trying just to convince myself to buy this stock, right? That's not what this is at all. We'll accidentally stumble upon an Apple if hypothetically we're bullish U.S. stocks, we're bullish technology, we're bullish large cap tech, then we might find ourselves into Apple. But just to give you kind of an idea as to what the differences are. And then another reason we look overseas is really for real diversification, guys. This is just a simple matrix of a correlation coefficient over a given year. On the y-axis, you have all of the U.S. index, all the U.S. sectors, financials, consumer discretionaries, tech, staples, healthcare, utilities, materials, energy, and industrials. And then on the x-axis, you have the exact same thing. And then where the cells meet is the correlation coefficient between the two. So the more green you see it, the closer to 1 that the correlation is, and therefore the more they move together. the more gray and brown you see it, the less they are correlated. The closer to -1 they or to 0 they are, and the less they move together. As you can see here, except for maybe a little bit in the utility space, all of the U.S. sectors move together because they are essentially U.S. stocks for the most part. This matrix here in and of itself, I think, really makes my case. Here we're looking at the same matrix, but instead of 10 sectors relative to the others, you're looking at 20 countries compared to the other 20. So notice how there's a lot less green here and a lot more browns and oranges and grays, and that's because by looking overseas, you're really getting a portfolio with assets that are less correlated to one another. So just wanted to show you guys that to kind of try to make my point. So let's get into how we're going to analyze any chart with a simple 3-step process. This includes stocks, bonds, ETFs, commodities, currencies, futures. It really, from a price perspective, it doesn't matter what the security in question is or the asset class. We're talking supply and demand dynamics, folks. So the first thing we're going to do is identify the direction of the underlying trend. Then we're going to look for support and resistance levels, and then we're going to analyze momentum for either divergence or for confirmation purposes. So the first thing we're going to do, guys, this goes back to Dow theory. Back in the late 1800s, Charlie Dow writing down his Dow theory tenets in the Wall Street Journal. Fast forward 130 years later, here we are talking about the benefits of Dow theory. The first thing we got to do, guys, is identify the primary trend. Are we in an uptrend? Are we making higher highs and higher lows? Or are we in a downtrend, making lower lows and lower highs? Or are we in a sideways trend where there is no directional bias? The first thing we need to do is identify that. And, while this might seem oversimplistic or whatever the case may be, guys, this is the most important thing that we can do. And it's the first thing we want to do when we're analyzing any chart at all, is to say, well, is it going from the lower left to the upper right? Or is it going from the upper left to the lower right? It's very important to understand the trend that we're in. To do so, to help with this trend recognition, I use a smoothing mechanism. I prefer a 200-period simple moving average. Again, this is simply as a supplement to price. Price is the only thing that pays. So when you talk about what JC's favorite technical indicator might be, it is absolutely price. And I couldn't even tell you what second place is because it's so far down that list. So price is number one, and everything else is supplement. Here again, we're using it to supplement with trend recognition, guys, not for support and resistance purposes. In other words, we're not buying a stock because it's at its 200-day moving average, or we're not going to sell a stock in an uptrend because it's at its 200-day moving average. That's not what this is about. We're looking mostly at the direction of the moving average. Is the price trending higher and the moving average trending higher? It's kind of hard to argue we're in a downtrend if both price and the 200-period simple moving average is moving higher as well. Here's a good example. Here's U.S. Treasury bonds in 2014. Just a very simple, let me just grab this, very simple uptrend above an upward sloping 200-day moving average. Here's our momentum indicator, which we'll get into in a second. But nonetheless, series of higher lows, higher highs, all within above an upward sloping 200-day moving average, as opposed to what it was prior. A downtrend making lower lows and lower highs below a downward sloping 200-day moving average. So things change, and we use this smoothing mechanism to help with that. And I'd be remiss if I didn't use financials back in 2008 as the perfect example of a downtrend. Here, rather than being a buy the dip sort of environment, like in the previous example here, this was a sell any rip environment where we are making lower lows, lower highs below a downward sloping 200-day moving average. So this all day was a downtrend. There's zero doubt about this, and we want to be selling into rallies, not buying dips. Had you listened to Charles Dow, you would have known that this was a downtrend, right? There was no reason to be in it. And then, of course, the infamous lack of trend, which where we have price oscillating in a sideways range above and below a flat sideways moving smoothing mechanism. This, I got to tell you, is really the cause of a lot of headaches. Guys, if you're a big fan of having headaches and, getting migraines, buy and sell stocks near a 200-period moving average. Be my guest. Myself, I have enough headaches. I don't need that. So whenever I see price near a flat 200 period moving average, stay away. And this goes, when I say period, guys, if I'm looking at a daily chart, we're talking about a 200-day moving average. If we're looking at a weekly chart, we're looking at a 200-week moving average. So just wanted to clarify that very quickly. So once we know the underlying trend, now we want to look for entry points or points to sell, a given stock or commodity or whatever the case may be. And for that, we turn to support and resistance. And guys, this is what we call polarity. Okay, so here we're looking at an example. Let's call this level $40. And let's just call this stock Microsoft, right? So, and again, this is strictly just a hypothetical. And every time Microsoft gets down to $40, it bounces, right? And why is that? That's because there is support here. And what that means is that there is an overwhelming amount of demand relative to supply. There are more buyers than sellers at $40. For whatever the reason, we don't care why, but for whatever reason, we know there is demand. There's more demand than supply at $40. And then eventually, the more times the level is tested, the higher likelihood that it breaks, okay? And when that breaks that $40, what the market is suggesting to us is that now, where there was more demand than supply at $40, now the sellers have taken control. And now at $40, there is more supply than demand. There are more sellers than buyers at 40, which is why on any kickback to former support, that level turns into resistance. Why? The market had already told us that where there was more demand than supply has now become the opposite. There is more supply than demand, which is why price fell below 40. And now when you retest that, prices roll over and is met with overhead supply. That's what we call polarity, guys, when former support turns into resistance. And it works both ways. Let's just use the same Microsoft example where every time price runs into 40, it sells off. Why? Because there's more supply than demand. There's more sellers than buyers at 40. And then eventually, if and when price breaks through that $40 level, the market is suggesting to us that now, where there was more supply than demand, where there were more sellers than buyers, is now the opposite. There is more demand than supply. There are more buyers and sellers at 40. And that's what the market is suggesting once we break through resistance. So if we know there's more demand than supply, when we kick back to that former support, it is met with buyers because, again, that former resistance turns into support. Where there were more sellers than buyers, now is the opposite. Now there are more buyers than sellers, and then that's when you get the polarity. So I hope that explains that. Let's just show a couple of examples. Here we're looking at semiconductors. These are the chip stocks back in 2011. Clear support right around this 32.5 area. Every time we get down here, it bounces, 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 and then boom, we break down. And what is the market suggesting here at the end of the summer? Very simply that where there was more demand than supply, where there were more buyers and sellers, now is the opposite. Now the sellers have taken control, and we know right above 32.5, there are more sellers than buyers, which is why when semis rallied back into that level at the end of 2011, it rolled over because we know from prior experiences that there were more sellers than buyers. Here's another example here, dollar CAD. So this is the US dollar versus Canadian dollar, just to show the supply and demand dynamics of the market are seen across asset classes. Very simple. This was all resistance throughout 2010, 2011, right? And then eventually at the beginning of 2014, we broke out, right? So where there was more supply than demand, where there were more sellers and buyers, once we broke out, we knew it was the opposite, and sure enough, the demand came in and we were off to the races. So the last final step that we're going to do is we're going to analyze momentum, guys. There are an infinite amount of momentum indicators out there. I personally really like the relative strength index. This is a 14-period RSI. I've been using it for a while. It's very easy to use. It's very valuable, and it's consistent. And again, this is strictly as a supplement to price. Now, when I mentioned the relative strength index, RSI, this is much different from relative strength. One has nothing to do with the other. Relative strength is when you're comparing one asset to another. So, for example, financials over the last month have outperformed the S&P 500. So they're showing relative strength, right? When we talk about RSI, we're strictly talking about momentum. And then when I say period, like we mentioned earlier, if we're looking at a daily chart, we're using a 14-day RSI. And if we're looking at a weekly chart, we're looking at a 14-week RSI. And this is an oscillator, which is a word many of you may have heard already. And all that means is that the indicator goes from 0 to 100. Okay? That's really all that means. So this is a momentum oscillator. So there are two ways that I use momentum. The first one is very simple, just to see what sort of range we're in. Are we in a bullish range or a bearish range? So when we look at RSI, traditionally 70 means overbought and 30 means oversold. But when price is in a strong uptrend, okay, and prices rally, we tend to get overbought readings on those rallies. And then when price is correct within an ongoing uptrend, momentum never gets oversold. Momentum tends to find support around 40, and the strongest uptrends tend to stay above 50. So right off the bat, we can look at RSI and see what range we're in. Are we getting oversold? Are we getting overbought? Are we getting overbought and not oversold? Right? That's a very good indicator. And then sure enough, it goes both ways. So we're in a strong downtrend, right? When we sell off within a downtrend, we're going to get oversold, right? We're going to see oversold readings below 30. But on those counter trend rallies within an ongoing downtrend, we're going to fail to get overbought. If prices start to get overbought, you know something has likely changed. Now, the second way that we use momentum is, think of it like a tennis ball, right? You throw a tennis ball up in the air. That momentum is going to start to slow down before it hits its peak, right? And we can see that happening even with our naked eye. It works the same way in the market. So here's a good example. Here we're looking at a beautiful uptrend, higher lows, higher highs. And then momentum on this higher high, right? What you want to see is when prices are making higher highs, you want to see momentum making higher highs as well. If price makes a higher high and momentum puts in a lower high, that's what we call a bearish divergence and is a warning of a change in trend. Not necessarily a reversal in trend, but certainly a change. And here we went from an uptrend to a sideways trend, and then down we went. And notice how once momentum got oversold, we knew something had already changed. Before we even broke down, momentum was already signaling that something had changed because it got oversold for the first time in this entire trend. And it works both ways on the way down. When you're in a downtrend in price, you want to see prices making lower lows. You want to see momentum making lower lows as well. If you see price making a lower low and momentum puts in a higher low, that is suggesting that something is changing. And that's what we call a bullish momentum divergence. And again, doesn't necessarily mean that the trend is going to reverse, but certainly a change. And then here, of course, we got a sideways trend, and then momentum started to get overbought, and then off to the races. But momentum was warning of that way before. And by the way, this is actually a real chart. This is silver back in 2012. And then here's the actual chart. Here we got a beautiful downtrend, bullish momentum divergence in summer 2012, change in trend, off to the races we go. This is one of my favorite examples of all time, guys. This is the US dollar in early 2009, beautiful uptrend, but on that last high, momentum put in a bearish divergence, and down we went. Big problems for the US dollar, and momentum was already telling us that something was changing. And then finally, here is gold miners. This was at the beginning of this year, one of the biggest runs in gold miners in history, really. And again, I mean, you couldn't ask for a more textbook bullish divergence. You had a failed breakdown here below all of this 6 months of support. Notice how momentum didn't even get oversold when we broke down. So beautiful trade. You know, I know at All-Star Charts, a lot of us benefited for sure. But again, this is just one good example of many, many out there. So finally, the last example I want to show you, kind of bringing everything together. Here we're looking at support in the Russell 2000 in 2015, right? See that? And then we know, since momentum here never got overbought, we knew this was still a downtrend. So we broke down, and when we kicked back to that level, momentum never got overbought. We knew something was wrong here. Sure enough, we crashed over from there until we put in a bullish divergence earlier this year. Notice that we made a lower low in the Russell 2000, momentum put in a higher low, and then you get the rally, guys. That's how we incorporate it all together and really bringing in momentum and trend recognition all together to find good opportunities. So without further ado, let's talk about today's market environment. Let's go over some trade ideas. The first one I want to talk about today is Netflix. You know, this to me is just a man, it looks like a monster uptrend as far as I'm concerned, guys. Huge uptrend channel, going back well over a decade. And, you know, this to me is still an uptrend. So we're going to start with a bigger picture outlook, right? That top-down approach. And, you know, this to me suggests that we're heading up towards the upper end of this range, right? So now let's break it down to the daily time frame and then see what we can do. So here I have some annotations drawn because this was a buy as soon as we broke out above this downtrend line, right? And, you know, we hit our upside objectives already, which is that former resistance. But notice how we've been hanging around and lingering around here. I think we break out here and we head up towards 165, 166. So what's the trade? I think if we're above 130, we could be long Netflix for a trade for another 35 points. So we're not above 130 right now, so it's something that we'll be watching. But if we are above 130, we want to be long Netflix and look to take profits 35 points higher. From a risk-reward standpoint, that looks pretty solid to me. Moving over to the currency markets, guys, this is one of the more interesting scenarios I see out there. Here's the U.S. dollar index. I don't know if you guys caught the Economist magazine last week with a picture of George Washington on the U.S. dollar bill, but like a George Washington that had been on steroids for too long, like with many muscles and whatnot, kind of signaling that the Economist is bullish on the U.S. dollar. And if we've learned anything about economists, is that they're completely useless. So when we see that sort of thing, it's kind of an eye-opener. So here we're looking at the U.S. dollar index here in blue, and then here we're looking at the euro in black. And remember, the euro represents 60% of the U.S. dollar index, right? A majority. So when the U.S. dollar broke out to new highs last month, the euro did not make new lows. So I see a very interesting divergence here in the euro between the dollar index. So the way I look at it is that this has potentially a failed breakout written all over it, and I think the trade is simple. If we are below 100 in the U.S. dollar index, it's a short down to the low 90s. It's that simple. If we're above 100, then this breakout is for real, and the euro's probably going to get crushed. But if we're below 100, I like the U.S. dollar index short. You can look at UUP, dollar index futures, a whole bunch of different ways to do it. Next trade is U.S. Treasury bonds. These guys have been absolutely decimated, and all of our downside objectives have been hit. I think a mean reversion here is certainly in the cards. So if we're above 120 on the TLT, we want to be long TLT for a mean reversion back to 130. So 10 points of upside with a very limited amount of risk, I think is a tremendous risk versus reward opportunity if we are above 120 bucks. Now a couple of I got a couple of ag names for you that I think look great. This is Mosaic. You know, my predecessors early on taught me. They said, JC, the bigger the base, the higher in space was the old saying. And the way I look at it here is we have a monster base being built here, and I think that the resolution out of this base is going to go higher. Notice how the downward sloping 200-day moving average has now flattened out and begun to slope higher. So if we are above the highs from 2016, we want to be long Mosaic for potentially a 50% move higher. And then Potash, also very similar setup. I think this one's already gotten going personally. You know, again, base throughout 2016, downward sloping 200-day moving average, flattening out and now rising higher. If we are above the downtrend line from 2016, you know, call it 17.5, we want to be long Potash, POT, and you know, we want to be taking profits in the mid 20s. So again, both Mosaic and Potash with potentials for 50% of room to the upside. So let me give you guys just a quick, before we get into my favorite chart in the world, let's just take a little sneak peek at allstarcharts.com. All of our members get access to my personal chart book, which includes over 450 annotated charts. Guys, I annotate all of these charts every week, okay? These are all of the commodities, all of the currencies out there, all of the stocks in the Dow Jones Industrial Average, another list of equities, all of the major indexes, both U.S. and abroad. They're updated every week, and it really allows you the opportunity to piggy bank on the hard work that I'm already putting in. So if you think of the chart book as the pieces of the puzzle, I send out a weekly newsletter. It's actually going out tomorrow. Think of that as the way the pieces of the puzzle really fit together. It's a snapshot of my views in the market for that particular week. We talk about what's changed, what stayed the same, And obviously, there are a ton of actionable ideas with the targets all outlined in every single newsletter. Casey wants to know why I use logarithmic charts. Because markets move based on percentage moves. So if you're looking at a chart that goes from $5 to $10 is a 100% move. So it should look as equivalent as a move from 50 to 100, as opposed to 50 to 55, which would be a 10% move. So that's why, Casey, I use logarithmic charts. So I have a trade ideas page as well. This is great for members who are short on time. What this is a running list of all of the trades that are outlined throughout the entire research platform, whether it is on a newsletter or on a monthly conference call or on, I do a lot of bonus research reports as well. All you have to do is go to the trade ideas page, allstarcharts.com/trades, and just click on any of the trade ideas, and it will take you directly to where I'm commenting on that, the chart, explaining the risk versus reward propositions. And then finally, listen, our members, we get a lot of feedback from our members, and it's clear to me that the monthly conference call is their favorite part of the membership. It's actually, our December call is next week. It's usually right around the middle of the month. And it's really just a market roundup where everything's going on, very interactive Q&A with our members. I'll start out by talking about some of the things that I want to make sure we discuss, of course, and then kind of open it up and be like, all right, guys, what else do you want to talk about and whatnot? And then they're all recorded, so you can go back. If we have members all over the world that just 7:00 p.m. Eastern time just doesn't work for them. So they'll be able to watch it at any point, and then you can go back and watch the conference calls in January and see why we were so bullish in January and February after being so bearish for so long, and why we got so bullish in July, equities, not even caring about the stupid election. We're technicians, we're market participants. You got to leave politics out of your portfolio. So just to finish up with the chart, with All-Star Charts, we have a members forum. We're lucky that we have some of the smartest members in the world. These are traders at household name hedge funds that you all know and are familiar with, RIAs and professionals for sure, as well as retail investors. So you're getting perspectives from all different walks of life. And, I'm fortunate that our members have really nice things to say about me. Here's Neil, says, JC's style fits exactly what I want. He looks for high risk reward trade setups based on the weight of the evidence and then offers specific stop and target points. Neil says that purchasing his membership was probably the best investment he ever made, helps him make money, and it's a fantastic educational experience. Nathaniel in San Francisco says, JC makes you think like a trader. Rather than follow someone else's alerts, you don't learn that way. With JC, you have the chance to be a trader who can think for yourself. And then finally, Jack in Orlando says, All-Star Charts is a fantastic service. The level of dedication JC puts into his work is astounding. And not only does he provide you with a multitude of trade ideas, but he also breaks down his reasoning so you are learning in the process. Highly recommended. Thank you so much, Jack. So what's the price? Well, normally it's $3.97 a quarter, but if you are willing to invest in yourself, I'm willing to invest in you. What we're going to do is we're going to knock that off at $297 per quarter. This includes the chart book, the weekly newsletter, the trade ideas page, the monthly conference call, of course. And then what we're going to do just for today, we're going to offer a 30-day free trial. So you don't have to pay a penny, free 30 days, but there's one small catch. This special discount is only good until tomorrow at midnight, guys. It's a free 30 days. So go to allstarcharts.com/free trial and get your 30-day free trial right away. allstarcharts.com/free trial. This is what it looks like. Just fill in your name. And again, like I said, you get the chart book, the weekly newsletter, the trade ideas page, and of course the conference call. But more importantly, we're going to give you a special bonus. Guys, if you go to allstarcharts.com/free trial, you are also going to get direct access to me. You can contact me at any point directly with any questions that you have on your portfolio or something about my process or one of my trade ideas, anything you'd like. Just simply fill out the contact form in our members area, and I'll get back to you within 24 hours. So finally, guys, I want to talk to you about my favorite trade in the world right now. What I think, I like all those trades that I mentioned earlier. But guys, I really like this Int'l. First, let's look at things from a bigger picture outlook. Here is Intel from the peak in 2000, right? And then look how long it took to base after the crash in Intel. It took well over a decade. You know, we're talking potentially 15 years of basing. So talk about the bigger the base, the higher in space. Guys, I think a breakout here is imminent. There are two ways to take advantage of this from a longer term perspective. I would be a buyer of weakness down into the low 30s if we get down there, or I would be a buyer on a breakout above 38. I think we're heading back up to the 70s. So either one of those, depending on your time horizon, I think would be a profitable proposition. If you want to be a little bit more nimble and you're a little bit more short term, I would wait for the breakout. So here's a shorter term look. Here's 38 bucks. I think it gets above 70. So risk reward wise, hello, monster room here. So I think this is another tremendous little mini base, right? So here we have a monster base, and then we have a little mini base. Some like to call this a cup and handle or whatever silly name they've come up with. Quite frankly, it doesn't really matter what you call it. You have a monster base, a breakout, and then a little mini base here. And I like it above 38, and I think we get into the 70s, guys. So I 100% suggest that you take advantage of the 30 days for free. It doesn't cost you anything. You might even learn something. Go to allstarcharts.com/free trial. I hope that this was. I hope I was able to add some value. I know we have a couple of minutes, so if you want to take any questions, I'm happy here to talk about it. I know Bill wants to know about using Fibonacci with candlesticks and moving averages. Yeah, I use Fibonacci. We didn't have time to get into that today, Bill, but if you'd like, and this goes for all of you, if you want to email me at jc@allstarcharts.com, I'm happy to send over information on things that I've written and work that I've done on Fibonacci analysis, both for price projections and things like pullbacks and things of that nature. You can go to allstarcharts.com/free trial, and then just go ahead and use the message center and email me. Happy to send you more work on momentum, my list of books, Fibonacci, and whatnot. Glenn wants to know, do you charge my credit card when I sign up? We do not. It's not a 30-day risk-free trial. It is a 30-day free trial. We're confident that you will be happy to renew and continue to be a part of our community. It is, without a doubt, the fastest growing technical analysis research company in the world. And, you can go to allstarcharts.com/testimonials, see what everyone has to say. But, again, I urge you to take advantage of the free trial. It's not, I think we've only done this once before, so not something that we do often. Just get in there, sign up, and be a part of it. You'll get a weekly newsletter tomorrow. All of the charts in the chart book will be updated by tomorrow. And next week is our monthly conference call, which is certainly a member favorite. Renee, did you have any other questions?
I did have one question from Ron, and he was interested in what you think will happen to oil.
What I think will happen to oil? Well, I don't have my charts here specifically. Feel free to go to the, sign up for the free trial and then just go to the crude oil charts, and you can see everything, for a fact. But in the short term, our upside objectives in the low 50s have been hit. But structurally, I do think that we're heading to $60. So, 60, 61. So I think it really just depends on your time horizon. And again, you can see exactly what I'm referring to if you go to the chart book. Once you sign up for the free trial, just go to the commodity section. Oil is it's like the third chart after the CRB index. All right, so I guess that's it. Renee, thank you so much for having me here today. I'm glad I was able to get all through that, in the short time that I did have. But guys, I urge you, allstarcharts.com/free trial, sign up, and then just shoot me an email on the contact. Be like, hey, JC, just saw your webinar, Investor Inspiration. I have a few questions, or if you just want to email me and say hi, I'll be around. So thanks a lot, guys.